Hi, this is Nora De Silva. I'm interviewing today a mortgage specialist, works with RBC, Ray Siger. Hi Ray, how are you doing?
Hi Nora, I'm good, thank you. Thanks for having me.
Thank you so much for coming today and your willingness to share your experience and information with us.
Absolute pleasure.
The first question, how many types of interest are there? Which one is better and why?
So there are two types of interest rates. There's a variable rate and a fixed rate. Fixed rate is a rate that's based on a duration of a contract or the term between you and the lender. And during that, or in the duration of that contract, you know exactly how much interest you're paying and it's not going to change on you. Every payment you make with a fixed rate, you know exactly how much is going towards principal and how much is going towards interest. The other type is variable, whereas you're directly linked to the prime rate from the Central Bank of Canada, and hence the overnight rate, which is also built on the prime rate of the bank, and then you get a formula for it. In that formula, it's prime minus X number. So however much the prime is, minus X, that's the interest rate. So if it goes up, you know, you're going to pay higher interest rate. What that does is when the interest rate goes up, your payment may stay the same depending on who the lender is, but how much of that payment is going towards interest will increase, and how much of that payment will go towards principal will decrease. Hence, it's going to take you longer to pay off that. Of course, vice versa is correct as well. The opposite is correct. If the interest rate goes down, more of your payment is going towards your principal, and less of the payment is going to go towards the interest. Hence, you're going to pay the loan much faster.
Okay. What is the reason behind the increase of mortgage rate?
It's arguable, but basically it's inflation. So we were presented with a situation where everybody had to be on lockdown during COVID. Now, what happens when you're on lockdown, it's like you have a steam engine train, and that's your economy, and it's moving at full speed, and then you pull the handbrake. It stops. So once it stops, the government has to take measures to make sure that it restarts this economy again. And one way of doing that is basically dropping, what we say is you're putting the economy in ICU, in a hospital.
Wow.
So when you put the economy in ICU in economic terms, you're talking about lower interest rates, dropping your interest rates, and increasing your fiscal spending. Fiscal spending meaning what the government gives out as grants and things like that. And what that does, it creates an abundance of cash in the market. People will be encouraged to go out and buy things, and that dollar will go from my pocket to the next person's pocket to the next person, and it goes into a full cycle, and slowly, that's what happens to get the momentum back in the economy. Of course, there is a side effect to that when you don't, you know, because it's so difficult to time when do you stop that and when do you do it. And just like you have a patient that you put in the ICU,
I love your examples, right?
What's that?
Make it easier for us to understand.
Thank you. So just like you have a patient in the critical care in the ICU, if you leave them there for too long and they've gotten better, there is a risk of infection that happens. It's the exact same analogy. If you leave the interest rates too low for too long, that healthy patient or that recovered patient is going to get sick again, and you have that side effect. So that sickness is called the inflation. What you need to do, inflation itself is not something terrible. Right? It's not dealing with, it's a normal mechanism that happens in the economy. It goes up and down. What's terrible is not taking the right course of action to control it, to tame it. Because what could happen is that it becomes what's called an entrenched inflation, meaning that it has dug itself in the economy. No matter what you do, you're not going to be able to bring it down. It will be out of control. So that's what happened with the inflation and where we are with it.
And who's responsible to put it back?
So the central banks usually. The central bank is the entity that decides the policy for the monetary policy, and it sets its course depending on what the market is doing and how it's behaving at that time. Of course, there is no such thing as a course of action for the next 10 years. There is a general idea, but there are a lot of variables that come into play, and you have to adjust. So that's why sometimes you hear somebody saying, I expect the interest rates are going to go down in about a month. And then something else happens, and then the announcement comes and nothing happened. So that's because there was a variable that changed than before that. So when you take that into consideration, it's not an easy job, it's not an easy balance to do it, but it is a necessary pain that you have to go through whenever you're presented with a situation like this.
So how much was the interest rate before, and how much it has changed after COVID?
So during COVID, the interest rate was dropped from the central bank to a quarter, so 0.25, and the prime rate from the banks at that time was around 2.45. Today, the prime rate from a bank is around 7.2. So there is almost 5% increase in that cost of funds. Of course, there is less money to go around now, so also the funds are going to be more expensive. But to put things in perspective, at 2.45, every $100,000 you borrow over 25 years, your monthly payment would be somewhere around $423 to $430. At this moment, every $100,000 you borrow is around $650,000 or $50 to $70,000. So sorry, $650. So there is almost a $250 increase in monthly payment for every $100,000 you borrowed. If somebody's got a mortgage payment of a mortgage balance of $1 million, then we're looking at $2,500 increase at the time of renewal, if things stay the same way they are right now, or if you have to renew right now.
Okay. So is there any time frame that when this increase will go back down again?
There are expectations and there are speculations. Of course, I just want to reiterate that everything what we say in this is not a financial advice.
Okay.
So, there is not one person that can predict exactly or time the market, or basically plan based on what will happen in the market. Because there's a saying, if you play chicken with the market will beat you 11 times out of 10. Right?
Okay.
It's a lot more powerful than you are. Of course, there is luck, there is timing, there are things like that, but it's very hard to figure it out. But in most recent reports, a lot of indicators show that the projection for the rate cycle to start going down will be in the second half of 2024. I personally think, and this is just a personal speculation, I think that we still have one more increase before the end of this year. If it doesn't happen, that's great, but I think it could happen just by looking at the inflation numbers, especially now that they've gone back up with the most recent report. So I think they will increase it one more time before waiting until the second half of 2024, and it's going to start pointing downwards. Now, the time it's going to take, a lot of people think that it's going to probably go back to where it was during COVID. I would say don't hold your breath on this, because that was not a normal situation. The normal situation is for the rate to be anywhere between, from the central bank, 2 to 3, which means for the consumer somewhere between 3.99 to even 5%. That's where it should settle down to.
Okay, so it never goes back to 2.5? Or
I mean, never say never, right? But that was a very that was a very specific situation. It was unprecedented. Nobody knew what we were dealing with during COVID. We didn't know whether we would be on lockdown for a month or 2 years or 4 years. So it really, there could be something like that in the future, but I wouldn't say this is the normal situation or that's where it should be.
Sure. I think it is harder to get a mortgage right now. Who is qualified to get a mortgage?
So I hear this a lot. It's hard to get a mortgage. It's easy to get a mortgage. Realistically speaking, or to be more precise, it always been the same, right? What changes are the parameters that are used in the formulas to qualify that mortgage.
Okay.
So, when you're dealing, there's something called a stress test. Stress test is when we say, okay, the interest rate, and this is just hypothetically speaking, let's say the interest rate is 1% today. But what if interest rate reached 3%? Can Nora still pay that mortgage off? Can she still have that mortgage paid?
Okay.
Right? And that's called a stress test. So, when you're doing it at 3%, is quite different than when you're doing it at 9.25%, which is where it could be right now. So, and what happens is, as when that number goes up, the amount that you can borrow shrinks as well.
Yeah.
Maybe that's what people mean when they say it's harder to get a mortgage right now, because policies are policies. The federal regulations are very clear. There is 3 things that you look at: the down payment, credit history, and the income.
Okay.
These are the main drivers of every mortgage application.
Yeah.
Does this person have enough to put in as equity?
Yeah.
Then I look at, will this person pay us back for that money that they're asking for? And then I look at, can they really afford that? And that's their income. So when you put things in that perspective, policy is the same, but it is much harder to obtain, to qualify applications because of the pricing of the market as well. When we're talking about properties, a normal property or the average in Ontario right now is around 850, but we're in Oakville, for example, right now, average price in Oakville for a detached home is no less than 1.5 million. So, if somebody's looking to put 20% down payment on 1.5 million, that's 300,000. They're looking at 1.2 million mortgage. So they need about 280,000 worth of income annually. Not everybody makes that kind of money. So that's the challenge. Now, will that challenge go away when the rates go down? Well, you still have to qualify for 1.2 million.
Yeah.
You may not need $280,000 worth of income, but you still need good income to qualify for that kind of mortgage loan.
Sure.
Right. So.
Sure. What is the minimum down payment of a house? You mentioned now 20%.
Yeah.
Is it the case in all the situations?
No, not necessarily. So, for first-time home buyers advantage, there's types of mortgages that you work with, and then first-time home buyers typically can go with a default insured mortgage. What that means is that there is a Crown Corporation called CMHC. Basically, it's an insurance company that, it's an insurance company that guarantees to the lender that your money is good, even though the client is putting very minimal equity. So if the property is less than 500,000, for example, the client can put, or the buyer can put 5% down payments, right? But then you look at it, is there a property that's less than 500,000 today? Very difficult to see, especially if we're talking about a family. Anything above 500,000 to $1 million, you can put 10% of that. Once the sale price or the purchase price reaches $1 million, you have to put 20%. Also, the type of or the purpose of the property plays a very big role. If in case of the 5 and the 10, that property must be primary residence. If you're purchasing something and it's an investment property, then the minimum down payment is 20% that you need to put. Then there is a third tier, whereas what's called non-conforming programs. Non-conforming programs basically, they start off at 35%. And these are more like your newcomer to Canada deals, a Canadian working overseas, a wealth accumulator, meaning that somebody that's close to retirement or maybe retired, they're not making any income other than their retirement income, but over the years they've accumulated a lot of cash assets in stocks and investments and things like that, then basically you qualify the application for this type of person based on their strength, their savings. And that would require 35% down payment. So it's case by case. It's very specific. I always say no two people have the exact same financial DNA, so you can't really present them with the exact same solution at the end of the day. It may happen, but at the end of the day, there's always differences between one person and the other. So there is no one ruler that fits all.
Nice. Okay. What is the score credit and how to build it?
Yeah, so credit score basically it tells you a story. It tells the lender a story of how good these people are with their obligations, their financial obligations. So it tells me about the character of this person, the financial character. I don't mean about personal. Does this person pay their debts on time? So if you have credit cards, are you paying them on time, or are the people who, the credit card companies calling you saying you need to make the minimum payment and things like that? Are you paying them off at the end of the month, or you're just paying minimum payments? It also tells me a story about the capacity of this person. So does this person have the ability to service the loans that they're asking for, pay the loans? Is there income? Is there enough income to do that? The collateral, meaning that a lot of loans they like, or lenders, they like to see that the buyer is putting something into this. So they're not coming and saying, okay, I want 100% financing, or I never want to invest my money. I just want to play with the lender's money, right? So these are things, the conditions of the loan as well. So these are all things that I get from just looking at your credit history. How do you build it? Basically, don't say yes to every loan you get. There's a lot of things that, you're at a gas station, you're pumping gas, and you get a summer student coming up to you and says, we have the best credit card in the world. Nobody beats our credit card because it's so good. It has nothing like that. And you look at it, okay, it's not a bank credit card. It's not, it's specific to a specific place. When you're trying to get credit, these may be a good option to build your credit. But then once you've established a credit history, you shouldn't be going and taking these types of credit cards. Because what happens with these credit cards, a lot of times they're not linked to your banking. So it's very easy to forget about their payments. Especially nowadays, where we get a mix of bills. Some bills come in the mail, some bills come in an email, some bills. So they tend to be overlooked. And what these do is, once you're late, they're reported and they take away from your from your score credit. The other thing is, don't allow just anybody to pull your credit. Right? So somebody that says, I'm going to pull your credit history, no, why are you doing this? So question it. Even if it's somebody that's applying for a mortgage or something like that, try to understand why are they doing this, right? So you have the right to ask these questions. They're not going to say, no, okay, we're not going to pull your credit, but we're still going to give you a mortgage. But at least they have to explain to you why they're doing it. And also, if there are multiple pulls in a very short period of time, as an underwriter, you're being told that this person is going from one place asking for a loan to another place asking for a loan to another place asking for a loan. Well, why haven't they really gotten any, right? So there's also that. So it's very, very important that you protect your credit history, and it's very important that you build it properly. Also, another piece where, if you have more than, let's say you have more than 35% balance on your revolving credit, your lines of credit, your credit cards, try to clear that on a monthly basis. Of course, not everybody can do it, but at least bring it down to less than 35% of the limits that you have. That shows the analysts that you're not somebody who's living off credit. And when you're somebody that's living off credit, and we're talking about 1,000 here, 2,000 here, 3,000 here, how do you expect them to give you $1 million mortgage, right? So, it's a catch-22. Also, one thing to keep in mind, I get a lot of clients that they sit in front of me and they say, I'm looking for X amount of mortgage, $1 million mortgage. And I say, okay, well, why do you think you can get this mortgage? And they say, I have an excellent credit, perfect credit score. That doesn't tell me that you have the capacity to pay this. Right? Yeah. So it just means that so far you've fulfilled your obligations. You've managed to make these payments.
But you might not be able to.
But this doesn't mean you can do that. Exactly. So, these are the things that, you have to keep in mind, and you have to understand that credit history is part of the equation. It's not the entire thing. Yeah.
Okay, nice. So in both situations, if the score credit is good or bad, that doesn't qualify us or disqualify us from getting a mortgage or a loan.
No. I mean, it may change the type. Yeah, it may. If the credit score is bad or low, let's not say bad. If the credit score is low, then there are things that you could do to bring it up. So if we have time, we work with the client to bring that score back up. If we see that it's a prolonged problem, then we may ask to get a cosigner, somebody with good credit history, to be on the application as well. If that's not available, then we can move down to the type of lenders that there are. So there are A, B, and C lenders, and each one of them, as you go from A to C, is willing to take more risk on it. Of course, this comes at a cost, right? So, an interest rate from an A lender may be at X. Interest rate from a B lender could be X plus 0.25, and from a C lender could be X plus 1. And of course, that's the price they will charge, that's the premium they will charge in order for them to take a higher risk on your file. So, but there are always solutions.
What is the tax amount due on selling a house?
So I think what we're asking about is capital gains. There is, of course, I'm not a lawyer or an accountant to tell you exactly how much it is, but there is a formula that is being used, and typically that formula is 50% of the profits. So, but there are deductions in there, and there are variable parameters that go into play, and that decides exactly at the end how much needs to be paid. Also, how many people own that property, how is that tax divided between them. So, with these types of situations, it's good to take a ballpark of 50% of the profit, but also you have to discuss, if you plan on selling an investment property, you have to ask your accountant ahead of time so that you can budget properly for this transaction. It's important to keep in mind that this only applies when it's an investment property. If you're selling your primary residence, then there is no capital gain tax that gets triggered when you sell it.
Okay. What are the benefits of first-time home buyer in Canada?
So there are a couple of main incentives that are there. The first one is basically a rebate, which is somewhere around $4,000 from the entire transaction costs, $4,000 to $5,000. There's also a benefit in terms of saving up for your down payment. So RRSP are registered retirement registered saving plans. Basically, those are parts of our salaries that we put every month into a retirement fund, and that retirement fund is invested over the years of our careers, and when we retire, that's where our retirement income comes from. If you take out money from those funds, basically you trigger tax implications, income tax, so it's looked at. However, if you're a first-time home buyer, you are allowed through a government program to borrow $30,000 from your RSPs, as long as you pay that back over 15 years. And if you do that, you're not going to pay any taxes on it, but it does help you build up your down payment, as a first-time home buyer.
What is the best to do now in real estate market? Is it buy, sell, or just wait?
I don't think there is an answer that fits all scenarios. It really depends on the person. So somebody who is, somebody who's currently renting and the rent is extremely high, and the landlord is telling them that they're selling the property, they have to leave basically, is different from somebody who's sitting on cash and they have a house and they're looking to invest, really. So, I think every person should decide based on their strategy and based on their situation. I don't think, yes, I understand that the interest rates are high right now, but realistically speaking, if this is my primary residence, I could buy a house today, take a 3-year term, and it'll be 7.1, for example. But in 3 years, I don't know how much the rate is going to be anyways. I don't know whether it's going to be 14 or 5.
Sure.
So it's really, if you're ready, if you have the funds, if you have the income, and you're capable of maintaining your monthly payments, and it's sustainable, and your job is stable or your income is stable,
Just
then
go for
do
it.
it.
Yeah.
I think that when it comes to primary residence, buying a house yesterday is better than buying today, and buying a house today is better than buying tomorrow. So it really is depending on the person's situation. I think from an investment standpoint, it really depends on the goals of the investor. At the end of the day, investments, regardless of what interest rate you're paying, you write that off your tax at the end of the year. So that might come into play when it comes to strategizing with your investments. And it's just a matter of calculating your cost of investment, and that's part of your cost of doing business. So again, I go back to saying it really depends on case by case. No two people have the exact same financial DNA, so you really need to look at it separately. And it's hard to give a one answer that fits all, type of thing. It's like Cinderella shoes, right?
Your examples, right? Okay. In some cases, people submit illegal documents to get a mortgage.
Yeah.
Even if they are approved to getting the mortgage, what are the consequences on the long run?
So, I mean, the law is very clear. It's fraud.
Okay.
This is considered fraud. It's over $7,000 usually, because mortgages. So we're talking about criminal charges if the lender decides to. So from a legal standpoint, they could charge you. A lot of people think that I could do this, and then once I have the mortgage, that's it. It's done deal. Nobody can come knock on my door. And yeah, the lenders, they try not to kick families out of homes, right?
Yeah.
Because it's bad publications, bad vibe altogether, and it's not good publicity to say that. But in a case where these documents can be audited at any given point in time, randomly. It could be audited by internal auditors, or it could be by OSFI, that is the the body that regulates all financial sectors in Canada. So once these documents get audited, usually it's very quick that you could see these are fake documents. So here you're presented in a situation, or the lender is presented with a situation where they're going to choose not to do business with this person anymore.
Okay.
So a letter is going to go out saying that we've discovered that you've submitted fraudulent documents, and as such we expect our loan to be paid back immediately. Now, depending on the market situation, you don't know if you sell the house, if it's worth the exact same amount that you bought it for, or you may not be able to move the house at a very high speed, or you may not have the funds at all. So it's not a good situation to be in. But again, you chose to do this.
Okay. So
right.
you expect some consequences.
Exactly.
At some point.
You chose to do this.
Okay.
You've taken the risk, and you should have known what the risks are, and you were willing to do it.
Okay.
So if you were still willing to do it and you went ahead with it, it's your signature. You can't go back and say, oh, so-and-so made me do it.
Okay.
It's your documents, your name that's on it, your signature is on the application, not anybody else's. So trying to blame others or saying, sorry, I didn't know any better, is not, it doesn't take a genius to figure out that forging a notice of assessment, which is a government document, is illegal. Right. So, but people still choose to do it sometimes, and of course these are bad apples. I don't like it. We get a bad vibe in the industry because of this. It causes cannibalization on other good people's opportunity. It causes prices to go up, because if everybody goes out and does these things, there are consequences. And of course, as technology advances in the sector, you got things like artificial intelligence and things like that.
Yeah.
These things are going to get less and less, hopefully, as we go on, as we progress. The financial sector is not immune to it. It's coming, and some of them have already implemented solutions. So, as these things happen, and as technology advances, a lot less of these scenarios are going to happen, or at least it's not going to be as they may seem to think it easy, right?
Perfect. So tell me, how does the life insurance relate to buying a house? Is it good to have life insurance?
So I'm not an insurance broker, and I can't really give very detailed advice about insurance, but I personally think it's very, very important, and I'm going to speak from my personal experience. I think we spoke about it earlier. We said, if you have a chicken that lays golden eggs,
which one do
would you insure the golden eggs or the
No,
chicken?
the chicken.
I'm going to insure the chicken.
Yeah.
So here I'm the chicken
Okay.
of the
Yeah.
house, right?
Yeah.
If I'm the provider and I'm no longer there, how is my family going to pay off that? Unfortunately, in depending on where you come from in different parts of the world, the mentality of how to approach insurance may be different. So you could have, I've heard everything. I've heard it's forbidden for religious reasons. I've heard, I don't believe in it.
Okay.
I've heard it's a big scam. They're just taking money from me just in case.
Okay.
But the reality is reality. You want to go buy a car, it's mandatory that you have insurance, right? And the car value is much less than a house value. So, you're not insuring this car because you have to. You're insuring this car only, but you're insuring this car because you may hurt somebody else with it.
Sure.
And that person may come after you. Now, it's the same thing. When I have big loans, I have to make sure that if I'm no longer there, nobody's going to go after my family saying, pay me back the loan, or they have to adjust their lifestyle and the what if happens and all of these things. So I think that every person that adds on liabilities or new liabilities to their existing ones, before they do that, they should sit down with an insurance advisor and calculate that as part of that ownership. So just like I know that my mortgage payment is going to be this much, I need property tax to pay property tax this much, but I also need to protect that asset. So how much do I need to pay to do that? So know these things ahead of time and don't overlook them, because doing this for the time that I've done it, I have seen very sad stories that have taken place. I have one of my videos, I share a story about it, and it was one of the most difficult situations I've ever been in my entire life. Looking at that person and telling them, sorry, you're gonna have to lose your house. You've just lost your husband, but he didn't have insurance, so now they're going to come after the money. So of course the lenders, and especially the big banks, they always try to work with different scenarios, but at the end of the day, it's money that's owed that's got to be paid back. So insurance here helps.
Thank you so much, Trey. Today we have enjoyed so much the information.
Happy.
And thank you for your time and everything.
Thank you so much, Noura. Best of luck.
Thank you. Thank you, and we'll see you again in the next episode. And I hope you enjoyed this one as I enjoyed it myself. Stay tuned.